Hello, it's Guy Costin, and I'm so excited to introduce you to Dakota Live Podcast. If you love Dakota Live and our allocator interviews, you're going to love the Dakota Live Podcast. It's hosted by Robert Moyer, one of our investment sales professionals, and the allocator. And just like on Dakota Live, in those interviews, we ask them all the pertinent questions about themselves, their platform, their searches, go really, really deep so you can get a deep understanding of who they are, what they do, and their platform. If you haven't had a chance to get caught up on Dakota Live Podcast, now's your chance to do so. You can do it right now on Dakota Marketplace, Spotify, or iTunes. You're going to love them. Welcome to Dakota Studios, the premier location for all of your video production needs. Our studio is located in the heart of Center City, making it easily accessible for companies of all sizes. Our professional production team is dedicated to creating high-quality videos that showcase your products and services in the best possible light. We understand the importance of video in today's digital age and are here to help you take your business to the next level. Whether you need a video for your website, social media, or to showcase at an event, we have the expertise and equipment to bring your vision to life. Don't miss out on the opportunity to showcase your brand and products in a dynamic and engaging way. Contact us today to schedule a tour of our studio and discuss your next project. We can't wait to work with you and help you take your business to the next level. Hello everyone, and welcome to the Emerging Manager Growth Show. My name is Guy Costin, founder and CEO of Dakota. I'm joined by my longtime partner, Ryan Creighton. Yep. Ryan, welcome.
Thanks for having me. First one for me.
First Emerging Manager Growth Show. It's been on Dakota Live a ton. Yep. So thrilled to have you all. So for those of you that are new to the show, this show is all about helping emerging managers understand the basic elements, what they need to do more with less. So the biggest issue, we've been working with emerging managers for a long time.
Since I joined.
And it just seems like just with Spruce, right, we're back at it with another emerging manager. So the goal is to do less with more. So talk just a little bit about the struggles that an emerging manager has and kind of, we're not going to go through the myths right now, but we've talked about it for 9 years, right? What are the things emerging managers need to know?
Yeah, I think, the main things for an emerging manager is just getting out there, one, right? A lot of people want to wait. But really you want to get out there and just get in front of buyers of who buy what you sell. And so setting up meetings with those folks as early as possible.
Yeah, and so when you talk about Ryan being captain of the North Carolina lacrosse team, you think about discipline, right? He joined, interned, taught him the program in 2014, and he's followed it to a T, and it works, right?
Yeah. You really just want to become a professional meeting setter-upper. Really. Right. Like that's what you want to do. You want to be calling on folks that buy what you sell and get in front of those people as often as you can.
Right, and so there's been a lot of chatter, okay, and I keep hearing it. Recession, is this a good time to be out visiting? Are people taking meetings? Are they doing in person? There's all of this noise, right, Ryan? The noise it's mind-numbing. So I'm going to tell you, I just asked our investment sales team to print out a few things so we can kind of demystify right now. Don't fall prey to conventional wisdom, CNBC, what all these other people are saying, okay? If you're a fundraiser, right, you gotta get out. Now, the way that we do it is we pick cities. For those of you that have been on this show before, we call it city scheduling. I'm gonna tell you, fundraising is a hard job, right? And listen, it's a hard job because one, high fees, recurring revenue, high margins. Everyone wants to be in the business, right? Private equity, private credit, long-term equities, fixed income. No matter what it is, it's a crowded space. The one way, however, that you can really distinguish yourself is simply by ignoring the noise, accepting the fate of being a professional meeting setter-upper. And that's kind of the theme as we're opening it up. That's what you can control, right? You can control. So our team in the next 4 weeks will be in Boston, New York, Chicago, Scottsdale, LA, Little Rock, Oklahoma City, Milwaukee, Atlanta, and St. Louis. I mean, what ends up happening is if you're an emerging manager and you can start with whatever town you're in, you don't necessarily need to have a massive travel budget.
Yep.
You just pick cities, and if you have a database like Dakota Marketplace, you can just pick that city, then go in and start sending your emails. And we have not seen what everyone else is kind of seeing. Now, listen, we're still working with boutiques. It's not like we're raising hundreds of millions of dollars this year, but we're still winning business. I mean, I have right here, a $40 million ad by a broker-dealer team at the home office. Sorry, everyone. We're being added to a Canadian UMA. This is just from this morning, right? Looks like we're going to the first. So we just so you know that even though we raised $25 billion, Ryan, even though we've been doing this for 16 years, just talk about Spruce launching with them. Just give a brief overview so everyone can understand.
Yes,
like we walk the talk.
Yeah, we're working with managers that are extremely early in their life cycle. As all of you who I'm sure dial it in are all emerging managers, and everybody defines emerging managers very differently, right? Everybody has a different definition for each emerging manager. But I think to have success, we all can follow the simple playbook that we've put together, which is the city scheduling that we talked about. A very, very simple concept of 3 to 5 cities on the calendar at all times. And whether you end up going to do those meetings in person or switching them to a Zoom, now I would argue in-person meetings are back. And these allocators are really looking for unique ideas across all asset classes. But to Guy's point of everything in the news, there's bad news, there's good news, who knows what's going on with everything. Some of the best times to market a strategy is when there's bad news, because you can be transparent with those allocators and they can understand your strategies much better.
Well, thanks, Ryan. And I just, when I look at what we have going on and I see the efforts that our team puts forth about getting those meetings on the books, it really changes the game. And the more volume, I was just on the phone of a subscriber, a good friend of mine, works at a very large asset manager here in Philadelphia. And he literally said to me, he goes, Guy, I have to do this on my own. And he goes, I guess by the volume takes away the pain of people not returning our emails. But part of what this show is about, and the reason we do this, it's a little group therapy, right? And it's more or less just like a pep talk to be like, look, you got to get out there and pick the cities, go into Dakota Marketplace. If you're not a subscriber right now to Dakota Marketplace, go into your own database and see who's in there and start rifling off meetings. Now, emerging managers, what we're really talking about is when I think of emerging managers, I simply think lacking brand and resources. Yep. So you're forced to be creative and do more with less, and generally what doesn't cost anything. So the format of today and what we're going to go through, number one, we're going to cover 3 sections of consultants as relates to emerging manager programs, OCIO, and consultants. Okay, so Ryan's going to go through that. I'm going to just walk him through it. Then we're going to go through the webinar. So right here at this desk, so we've been doing webinars since 2006 for Edgewood. The past 2 quarterly calls, they have come into this studio with their brand, and this is not, we already did a little promo just while people were kind of coming into the call about what you can do. They came down here, they shoot, and then we run it, right? It's all pre-recorded. The feedback that we've gotten now, I'm not saying you're going to come down here and do this. You just need to do a simple webinar to kick it off. But we're going to talk about how to do a quarterly webinar, the benefits of doing the quarterly webinar. And it has been such a grand slam for our business, I can't even tell you. And anyone who will listen, we're going to talk about that today. Yep. And to close out, we're going to talk about the emerging manager conferences. And now we're going to get into myths. So now, we're here for you to answer any questions you want. So please put your questions in the chat. There's already a bunch in here that I'm going to get to. But first off, Ryan, why don't we just kick it off? Because I do believe we know there's at least 4, and I'll read them off. Why don't you just comment on them? So when we talk about myth number 1, this is one of my favorites because this can cut across consultants, platforms, everything. Do I need a 3-year track record and XAUM before marketing?
No, no. Yeah. And I think The common myth, especially with the newer strategy, is, the consultants typically say you need this amount of track record, this many assets, and really you can market to all channels at all times. Now, the adoption rate might be a little bit slower, but in 3 years, when you do have that track record, you want the consultants and the field consultants and potentially even their end clients to know who you are and how you all invest and what the strategy is. So you don't want to wait until that 3 year, because if you wait until the 3 year, then it's 6, 7, maybe 10 years before they can allocate to you because they don't know the strategy. So really you want to get in there as soon as possible. And some might say, hey, wait, but you also want to be in their databases early.
100%.
And that's especially true with the consultants.
Yeah, and so couldn't agree more. So strategically, as an emerging manager, you want to make sure you're covering all of the RAs because they have discretion, they can allocate capital. It is harder, meaning just because you're sort of going piecemeal, if you will. Unbelievable channel. They're looking for great ideas. We're seeing that. But Ryan, we're going to go through right now in a couple minutes the different three groups of consultants. It's a little bit more R&D. There's fewer opportunities, but it's very important that you at least get yourself in front of them and they know who you are. And so myth number 2, conversely, I only need to cover the key consultants as they are the most influential gatekeepers.
Yeah, so that's one, especially for emerging managers. You might have less resources. You might have one salesperson. You say, okay, let me go after the largest consultants, the largest gatekeepers. And we know that that's just potentially a bad idea. You can really die on the vine going after consultants. So to Guy's point, you really want to be in all channels that will buy your strategy. And the RIAs, multifamily office, family office space are places that you don't want to neglect, especially they have discretion. They're always looking for unique new ideas that they can differentiate themselves to their clients.
Right.
So you really want to cover all of those channels and not just focus on, a large consultant that potentially down the line could be a huge allocator. You really want to have, I guess, your net cast across all channels.
Yeah, and so you need volume. And you need volume against channels that buy and invest in your type of product structure and strategy. So Spruce, our construction loan strategy, 14.5% net, okay? They invest in construction loans to multifamily. The reason I say that, we're 6 months in. We started in the fall. They have the second fund. They're brand new to the market. Now, they manage about just under $1 billion, so they've been around for 15 years, but they've only done the fundraising, kind of on their own. They hired us. Well, guess what? Lo and behold, we're going to investment committee for our first RAA this week. So pretty cool, right? Yeah. So we put our plan into place 6 months later, and this will kind of close out fund 2. But my point is, that's a greenfield opportunity, stone cold. We started stone cold, yep. Right?
And it being fund 1, the earlier investors in that's probably RA, multifamily office, family office, but that doesn't go to say that we're not covering all the consultants right now.
Right.
And we could get lucky, and you never know when there might be a search or a need in the asset class, but typically they want to see fund 2, fund 3 at these consultants.
Right, exactly. Okay, is it a waste of time to call on institutional accounts that only use a consultant?
No. It would not be a waste of time. I think a lot of underlying clients utilize consultants, but to varying degrees. So you can kind of play it both ways. You can call on the underlying clients. In some cases, their analysts will cover specific asset classes. They'll outsource other asset classes to the consultants in whole. So you really want to call on both.
Right. And I think the theme that you're going to see, that the theme that I hear from a lot of salespeople when they're asking questions is that they want to have an opinion before they call on someone of how that person might invest, right? And you really just want to make the phone call, set up the meeting, go do the meeting, as long as you know, right, that they absolutely invest in your product structure. So you can be very focused, but don't overthink it. Get in and just ask the tough questions. And I'm going to close this show with the biggest game-changing 2 questions that will change your sales career forever. You might already do it. We're not going to do it right now. These are the most game-changing 2 questions. So let's get into the consultants, Ryan. Okay, so emerging manager consultants. There's 3 categories. First one, emerging manager consultants.
Yeah, so the emerging manager consultants, these are going to be your consultants that are exclusively dedicated to emerging managers, evaluating and allocating to these managers. Many of these consultants are also focused on women, minority, diverse mandates. And think about their end clients being institutional in nature, a lot of these public plans. Exponents would be one here in Philadelphia. We recently had them on as a guest allocator.
Yeah.
Addix, Legato, Bivium, Leading Edge, and then Stable Asset would be more on the alternative side. But just a couple kind of key considerations when you think about these consultants. They're only looking at emerging managers. As a salesperson, you have to be very conscious and know up front that you're going to be negotiating fees.
Right.
They're going to be negotiating fees with you. They're going to be potentially wanting different vehicles. So you might offer an LP, they might ask for a separate account or a CIT. So you have to have some flexibility, I think, as a salesperson, especially if you're going to bring portfolio managers into these meetings. These are conversations you want to have up front with the portfolio manager and have a plan as to what fees are you willing to go to, what types of vehicles are you willing to have. They might ask for future capacity of your strategy. So having those conversations and preparing before you go into those meetings is crucial.
Yep, and like I said, when we conclude this call, we're going to go through these specific questions as we close that you should be asking to save yourself a ridiculous amount of time. Okay, let's get into the emerging manager programs. And by the way, one of the questions already was in here is how on Dakota Marketplace, is there a section for checking off the box, whether it's an emerging manager program or emerging manager consultant? And yes, all this information with all the proper contact info, everything is in Dakota Marketplace.
Yeah, so the second group that we're going to talk about are more of your large, big brand name consultants that have a defined emerging manager program. And they have resources dedicated strictly to emerging managers. So I'll start with Makita. They've significantly allocated to emerging managers over the years. They have 2 emerging managers days that are specific to both public and private emerging managers, to just full days of meetings with their research team. The last one they had was in October. They also have one this week on the 26th. As I mentioned, both public and private. We also said everybody defines emerging managers different. I quickly looked at what they look at. For them, it's $2 billion or less on the public side, never exceeding $5 billion, and a 10-year or less track record. And on the private side, it has to be a first, second, or third fund. No AUM capacity there. The following consultant would be Willis Towers Watson, a large global consultant. They do have a discretionary emerging manager model, so a good one as they have discretion. They're pretty, I would say, unique in how they work. They've worked with long-short managers and just asked for the short version of their book. So they can get pretty creative in the ways that they work. But think about them as they really want to be early in life cycles, especially in capacity constrained asset classes. So they want to be very early, take up capacity of the manager, and then move on. Some other ones, Stepstone, this would be more alternative real estate. Mercer, they've got a defined emerging manager program. Really with Mercer, you want to get in their database as soon as possible. We've seen that with a lot of our managers. The more you can kind of keep the database updated, the more inquiry you might get. Crucial works with foundations and endowments, so typically they're looking for more concentrated type of managers. And then Russell Investments, really large sub-advisory opportunity, both for public and private.
And that was one of the questions, is what databases are most important? eVestment, naturally, Mercer.
Callan would be another one.
Callan, Russell, obviously GMID, which is Mercer. And the more information that you can put qualitatively where you have an opportunity, the better when you're entering information. It's all shades of gray if you go in. Some managers outline their investment process in detail. Others have one paragraph. So the more information, the better. So when that due diligence analyst goes in, they can get up to speed on your strategy quickly.
Yeah, and I think it's just important, again, to hit this. And I know we talked about this with the myths, but especially with these consultants that do have the dedicated programs, you don't just want to be going after these folks. Make sure you're spending time on the RIAs, multifamily office, and family
100%.
offices.
And then To close it out, OCIOs?
Yeah, so these OCIOs, groups, consultants, however you want to talk about them, some of them might be RIAs. They have less of kind of your typical definition of emerging managers, but their philosophy and how they build portfolios lines up exactly with an emerging manager, a newer manager that less people know, less of a brand name. So really you want to get in front of them as soon as possible. Fiducian advisors would be a great example. We just had Brad Long on as a guest allocator, really embrace the boutique managers, the small managers, both public and private.
Differentiation, right?
Differentiation.
And right now, Fiducian consults to over 65 RIAs.
Yeah, and that list is growing quickly. And then some of the other ones, just to name off, would be TIF, Global Endowment, Strategic Investment Group, Edge Hill, Grosvenor would be one on the alternative side. And compared to the larger brand name consultants, where they might have an approved list as you get on, there's always a second sale. That's probably another myth. If I get on an approved list at a consultant, am I going to get assets? No.
Right.
With more of these OCIO groups, if you get approved, it's much more selective, probably harder to get approved, but you will get assets if they're in a discretionary model at these OCIOs.
Gotcha. And then you just want to talk a little bit about, as we close out on the emerging manager platforms and consultants, talking about Makita's
days. They've got the 2 days a year, one coming up this week. Their last one was in October. To the question that came in, talking about, is Marketplace checking this off? Can I go in there and run lists? So, think about the pensions. Lacera, CalPERS, State of Maryland will be a couple that really have dedicated emerging manager programs. Grosvenor on the private side, and then Fiducian will be another good one on the private side. And then there is a newer one down in Atlanta, Gridline.
Yes.
Think more alternatives.
More like a smaller iCapital.
Yeah, they're looking at kind of differentiated, concentrated type of managers.
Right, yeah. And so we did have a question that, how would you approach consultants and OCOs of your flagship fund as a hybrid strategy? It doesn't fit in a traditional bucket. Now, if you're talking stocks and bonds, that's probably not a great fit, but I don't quite know what hybrid means. Just if it's stocks and bonds, that's going to be a little more difficult. I think consultants are very much willing to look outside traditional style boxes.
Correct.
Right.
Correct.
Yeah. So the answer is I would absolutely cover them and get the know. To me would be the most important thing. It's a question about InvestNet. We're going to come back to that, but I definitely want to get to that. So the next thing we're going to do is we're going to talk about webinars. Now, upcoming conferences. So this is in our database. We have all these upcoming conferences. So clearly Morningstar is tomorrow, but as you can see, there's a bunch of conferences that you could choose to attend. You can screenshot this. They're all in our database. In fact, there's over 600 conferences, and we have them tagged as the certain emerging manager conferences. So there are a bunch of good conferences that are very much worth going to. And as we mentioned, Makita has their 2 a year. Now, as we move into quarterly webinars. So we've been doing this since 2006 with Edgewood. And basically, it's free, number one, to do it for the most part. And number two, you're able to completely curate how you want to communicate to your clients and your prospects. And so I always say to everyone, if we start fresh, Ryan, and we've seen this, and the numbers just grow and grow and grow as we take on firm after firm after firm, assume you're going to get no one, right, on the first call. Well, that's fine. Because what are you getting when you do the quarterly call? We talk about, just give a sense of the emails and the branding that goes out is all associated with just promoting the call, forgetting even the content of the call.
Yeah, I mean, it's essentially free marketing. We talk about how do you do more with less. And emerging managers, you might have less resources, but it's free marketing. It's free building your brand. You're a newer firm. You want to build a brand. So before the call even happens, there's 5 emails that go out pre-marketing your brand, what the call is, what you're going to cover. And then you also get to follow up on that as well with emails of this is what was covered, this is what was said, here's the transcript, all that type of stuff. But really, it's, can I be consistent with my client service? Can I be consistent with my prospects and how I'm communicating?
Now, the one very important thing that he just brought up that people don't understand sometimes, by doing a quarterly call and inviting your clients, your investors, then going through very thoughtfully what happened during the quarter, and then being able to provide really good insight. And it should be 20 minutes of prepared remarks, but you have to be able to get deep and granular and share information that's very valuable. So people are like, hey, I never want to miss that call. I learned so much on those calls. Hey, I'm an investor, right, in that strategy, and I want to be able to tell my clients or invite my clients to the call or send them a replay. And you can really make an advisor, an RIA, a family office, a foundation endowment, you can make them look really, really good to their boards and everything by producing a quarterly call.
Yeah, and the other thing that I would add, an emerging manager, right? Your portfolio manager might not be as comfortable telling the story. This is a great resource for them to prepare remarks of, this is what happened in the quarter. These are the changes that we made. Here's why we made them. And it really makes them kind of tighten the screws on their marketing. So it's almost free training for the portfolio manager as they're getting their messaging ready to go out and talk to others.
So as we said before, number one, it's free, right? Number two, you get 5 touches a quarter through email, right? You're going to send out a save the date, then you're going to send out a registration. You're going to probably send out 2 more, and then you're going to send out day of. And then what ends up happening is you do the call.
Yep.
Okay, now you have the replay of the call. That goes on your website. You transcribe the call. That goes on your website and gets sent out. You do an abstract of the call. So it's like, if you don't want to read through all of this, these are the key takeaways from the call. Well, that goes on your website. And that also is used as marketing material throughout the next quarter, right? When you're getting involved with someone, they're starting to do due diligence. It's like, hey, how can I expect to interact with you if I become an investor, right? One of the biggest things during the due diligence process is it's a interview into what it's going to be like working with you on a client service basis, right? And if you show you care this much to go in this much detail, be very informative, because most consultants like Greystone, we were very close to all the Greystone consultants, they take out their Word doc, they call each manager in a particular portfolio, they call them up for commentary, right? They copy and paste into one Word doc, and that gets sent to the client. Commentary for each manager. Yep. And a lot of times they're pulling teeth getting information out of you. Well, if you show someone up front, hey, this is what we do, this is what we'll send you each quarter, guess what? If you tie for first, it's like, wow, I could go with either strategy, but it's so much easier working with them. So this is, again, an audition, if you will, but you get all of this content and all this communication. And like I said, it's free, and people really get to know you. Now, if you want to take it to a higher level, which is awesome, you can do a Zoom call. And then on Zoom, you can see, right, but you want to practice to make sure things go well, and you can choreograph it. But that's huge in terms of the...
Yeah, and it's also great to have the archive. As you know, you think about a consultant sales cycle, it could be 3-4 years, and the analyst might have turned over at the consultant. Now the new analyst can go back and look at Q1 2020 webinar for XYZ manager and be comfortable in 20 minutes of what happened that year. Or, you know, it's a great way for a new analyst to get caught up to speed at looking at old webinars.
That's great. I'm really surprised about how many people actually don't do the webinars. Okay, so just to close out, as I said at the end, you end up creating all this content. You have the replay, you have the transcript, you have the abstract. There's just so many benefits to doing these calls that you can't even sometimes even think about until you do them. And what ends up happening is your clients really appreciate it. And as you said, Ryan, as hard as we're trying to get out and set up meetings and everything, it's just another great form of basically free marketing. Now, it does take your time, but it's free marketing.
Yeah, and it's easy to follow up on a webinar that somebody signed up to listen to.
That's another thing, is you take the registrants, then you can see who actually joined the call versus who registered, and then you follow up with all, hey, this is that, and you can put it in the email.
Hey, I'm going to be in your city at this time. I saw you signed up for the webinar.
Exactly, and that's... So, and again, we walk the talk. We will not work with a firm that doesn't do a quarterly webinar. So, webinars, unbelievable. A few questions from the audience. Are these quarterly calls also recommended for alternatives?
Yes.
Absolutely. We're doing one. We do our spruce calls, and it's just such a great opportunity for the manager to flex their muscle and show basically how smart they are. I mean, which is very, very important. Do these webinars to be live or can they be pre-recorded? We do both. Some we do live, some we do pre-recorded. It really comes down to your comfort level because you always have the live, at least you can do Q&A after, which I think is very, very important. So you can do Q&A on a live webinar. Now you can do planted Q&A in a recorded. You just have to plant the questions that you think somebody, how soon do you start sending out invites? That's a good one. So basically you have 3 weeks before the webinar, you send out a save the date. That's the main goal. You want to save the date. And then you also want to be thoughtful and have a catchy, just have a catchy little tagline to say what you're going to cover in addition to the normal table stakes type stuff. But it's always, with our long-only equity strategies, we always like to do a refresher on the strategy. This is how it works. This is what we do. About a minute on that. Then you go through winners, losers, additions, contributors, detractors. You go through all those details, what happened during the quarter. And then you get into highlighting an investment or two and going pretty deep on why you made that investment, why you like it. And it allows the listener to see in action your investment process, which again, these are invaluable. And the more creative you can be and add value during the discussion, the better.
That and keep it short.
Yes, keep it short.
It doesn't need to be an hour. It can be 25 minutes, 20 minutes.
Exactly, 20 minutes, works out great. Question. Okay, we'll close with this question. Then I want to leave you with two key things that I think it changed my life years ago. It can change yours. How can we figure out the pension endowments that are using a particular consultant? Well, in our database, Dakota Marketplace, we have all the field consultants, all the consultants attached to all the public funds, and also to different foundations and endowments. So, as we close out, we'll send you as a follow-up on this a webinar ebook, and then to wrap it up. So, Ryan, as we talk about, you go spend all your time getting all these meetings. You do the meeting. You're in the meeting. You're in the conference room. The whole thing. And the question you have to ask yourself is, when the meeting ends, am I asking the tough questions? And this is what I was saying earlier. What you're looking to do, especially with the consultants, right, is be very polite, but you have to ask two very tough questions. And if it's long on the equities, this is the question. Hey, Ryan, I really enjoyed our time today. Would this be an asset class that you would invest in? Would this be a type of strategy that you would invest in? Right? Don't assume that just because you're in the meeting, that's going to be a yes. Okay, let's get that question out there. If it's a no, guess what? Everyone's like, what's the follow-up cadence? How do I follow up? I said, well, the follow-up cadence is driven by the two toughest questions you ask in the room, right? Is this a strategy you guys would ever allocate to? Okay, if they say no, you know what the follow-up is. Keep them on your mailing list, email list, invite them to the quarterly call, et cetera. Secondly, if they say yes, long on the equities, do you see yourself doing a search in the next 12 months? No. We're really happy. This happened to me one time. We're really happy with Columbia, right? And it's like, but we wanted to know who else was out there. Well, now you're not going back to the office and Ryan's like, hey, Guy, how was your day of meetings? Oh, it was a great meeting, great meeting. Well, we banned that term because we don't want great meetings, right? We just want to know the facts. Like, what are we going to get involved or not? Is there something happening here? And then if they say we actually are going to do a search, now you have your follow-up because like, okay, what do you think? Do you need other teammates to get involved? What are the next steps so we can compete in that search?
Right.
If it's alternatives and you get through the first question where yes, we see ourselves allocating to a strategy like yours, simply say, well, that's great. Our final close is on 9/30/23. Do you think you can make that close? So getting the quick no is essentially the most important thing in sales and in the investment in the fundraising business. So getting the quick no solves so many problems. And you'd rather have that quick no than people ghosting you. It's like, well, we had this great meeting. We got along great. It seemed like they really liked the strategy. And I tried to do those follow-up and they didn't ever respond to me. Well, when you have them captive, ask them the tough questions. So that to me is the gold. Just to wrap up, we can't thank everyone enough. We have a bunch of follow-up materials we'll send out. And we will see you our next episode, which is on June 12th, episode 9 at 1 o'clock. Ryan, Thanks so much. Your insights were amazing.
Thanks for having me.
Really appreciate it. You got it. Thanks for being here. Thanks, everyone, for being on the Emerging Manager Growth Show. Hello, everyone. Just wanted to say thanks for watching. Hope you enjoyed the show. One thing that I think you do know is all of this information that we covered exists in Dakota Marketplace, our institutional investor database. Even this show that we just cut will end up in Dakota Marketplace so you can view it. And if you're not a member, we would love to show you the platform. Just simply go to our website and get a free trial of Dakota Marketplace.